Hey friends, it's Paula Tisch, your favorite Huntsville Realtor. Today I'm out at Lincoln Mill visiting with my friend Kari Brown from Redmond Mortgage, talking all things mortgage. Welcome to Kari Brown of Redmond Mortgage. She is here to answer all of our mortgage questions today. So first of all, Kari, can you tell us what is a mortgage and why do I need one?
So most people will need a mortgage unless you have a lot of cash on hand.
So let's say I want to buy a $350,000 house. That would get me a 3-bedroom, 2-bathroom in a lot of different areas around town.
Okay, so do you have $300,000 that you want to?
Not currently. No.
So then you would get a mortgage.
Okay.
So you would borrow that money from a lender, and then you would pay back that money with interest.
Okay. How long do I have to pay it back?
So typically people do a 30-year mortgage. You could do a 15-year. The most popular is a 30-year.
Okay, so now that I understand what a mortgage is, how do I get one? What do I have to do?
So the first step usually is to find a local lender, a local loan officer, and they're going to ask you typical basic questions on what your income looks like. Are you employed? Do you work hourly or salary? Just basic information. Do you know what your credit score is, roughly how much you want to spend on a mortgage? Because a lot of times what you're approved for is not going to be the best for your budget.
A lot of times a buyer will call me, they'll be shopping for whatever they think they can afford. They have no idea. They want to go looking at houses and I will point them in your direction, right? So one of the biggest questions I get from them is, well, is she going to do a hard credit pull?
So some lenders will, some loan officers will just do a hard credit pull right off the bat. Usually what I do is I'll do a soft credit pull. So that just gives me basic information on what your credit score range is, how many and what your liabilities are. We can also look at that time if there's anything derogatory on your credit. That might just be like, okay, we're not going to do a hard pull. We need to do some credit restoration improvement first. So that way we don't damage your credit score by doing a hard pull right off the bat when there's no reason to, when we can't move forward anyway.
Yeah, that makes sense.
Yeah.
Does the soft pull affect my credit rating?
It does not.
Not even a little?
Nope. It does not hit your credit report as a hard inquiry.
Okay, so you have done my soft pull. You found that I'm worthy of getting a mortgage. Now we're going to talk about what kind of mortgage I'm going to get. Okay, so what affects that?
So there's a lot of different mortgage types. A lot of times it's going to depend on what your credit score is. It's going to have to do with your debt to income ratio. It also has to do with maybe if you're going to use it for a primary residence or if you're looking for an investment property.
Let's start with just one of the mortgages and then we can talk specifics about each of them. So let's say a lot of first-time home buyers will use an FHA mortgage.
Yes.
So let's talk about that.
Okay, so an FHA loan is a government-backed loan. The FHA loan, you do not have to be a first-time home buyer to get an FHA.
Yeah, the reality of down payments is real. Because not only do they're going to have that money, then they're going to have the closing costs that you have to consider. And then now with the new buyer's agency commission agreements, the possibility of paying commission, which if you use me, I will absolutely negotiate that the seller pays that for you. So, but yeah.
Yeah. So a lot has to do with a good realtor to not have as much out of pocket at closing. But even some of the zero down options, like we'll talk about a USDA loan, is zero down. So you have a zero down payment, but a lot of people forget that on top of that zero down, you're still going to have to come out of something most likely.
Right.
You're going to have closing costs. You will be
fees.
Yep. You'll have home inspection, which would be a good idea to get.
$500.
So there's still going to be money.
Appraisal.
Yeah. So you're going to come out with something.
Okay. So let's say I'm getting an FHA for my $400,000 home. And 3.5% of that is going to be $14,000, right?
Sure. You're
Let's go with that.
doing math on the spot.
We're mathing. So $14,000. I mean, that's a substantial
That's a
down
chunk.
payment. Yeah.
Mm-hmm.
And then plus your closing costs and stuff.
Right.
So you need to be prepared to
Yes.
come up with cash. Okay.
Yep. So FHA is a good program to go with if you have a higher debt to income ratio, which means a higher percentage of your liabilities versus what you're bringing in.
What might be a liability?
So your liabilities that we look at, that the lender looks at, is just going to be anything that's on your credit report.
Okay.
So it's going to be car loans, credit cards, student loans. What we do not factor into your debt to income ratio are your utility bill or gas money or groceries. So although, like we mentioned before, you're approved for a certain amount, you want to make sure that you still have those extra living expenses, that you don't become house poor, as they say.
Are there any fees or insurances or anything that go with the FHA?
Yes, so an FHA is going to have an upfront mortgage insurance premium.
Okay.
So most of the time that is added into your base loan amount,
Okay.
or it's added into your loan amount to equal your total loan amount. You also have on an FHA loan too, you're going to have a monthly insurance, almost like PMI, same type deal on an FHA loan. So if you put less than 10% down on an FHA loan, you're going to have that mortgage insurance on the life of the loans.
Yeah. And that's forever.
Yes.
So that's a lot of payments over 30 years.
It is. But typically, people don't keep their mortgage for 30 years.
Yeah.
So I tell my clients that, if you need to get into an FHA to start with, and then you're not going to keep the loan for 30 years because ideally interest rates will go down and you'll want to refinance.
Mm-hmm.
So at that time you refinance, maybe your credit profile has improved, so you can refinance into a conventional loan.
Okay.
And maybe you have enough equity, so when you refinance into that conventional loan, you won't need mortgage insurance.
Okay.
So sometimes it's a good idea I always tell people, if you can afford the down payment, afford the monthly payment, go ahead and get in the house.
Absolutely.
Because you can always adjust your mortgage down the line when life happens, things improve.
Yep.
Yeah.
I agree with that. I find, especially like with renters, I'm constantly telling them, but pay yourself your rent.
Mm-hmm.
Let's get you in the house somehow.
Yeah, I include on my initial consultation that I do with clients that your appreciation in Madison County, or nationwide, is typically around 3% each year.
Annually, right?
Yes. So in Madison County, typically it's a little higher than that. So if you can get in and start building that equity and building that wealth. So that's why homeowners typically have a net worth of 42 times higher than renters.
Really?
Yeah. It's because you're gaining that equity, you're building appreciation, you're doing working on that generational wealth. It's just like a good idea. Yeah.
All the things.
Start building.
So the mortgage insurance thing is a good transition into the conventional loan.
Yes.
So tell me about a conventional loan.
So most people know about a conventional loan. That's probably the most popular that people hear about. A great myth is that you have to have 20% down for a down payment.
Huge myth, you guys.
And that is not the case. Most people I work with do not have a 20% down payment. A conventional loan, if you're a first-time home buyer, you can put a minimum of 3% down. It's going to have a little bit stricter on credit score. So they're going to want a little bit higher of a credit score, and same with debt to income ratio. So they want a little bit lower of a debt to income ratio. So that means you're not spending as much of your income on those monthly liabilities that are on your credit report.
So conventional is for people who have are in a little bit more secure financial place than the FHA.
Yes.
Okay. And then if I get a conventional and I put my 3% down, like, do I have to pay that percentage thing that you were talking about with the FHA?
No. So there is no upfront mortgage insurance with a conventional, but if you're putting less than 20% down, you are going to have private mortgage insurance.
Okay.
Every payment. So that's just like the FHA.
And is that forever?
So once you get to a point where you have 20% equity in your property, you can ask for the lender to remove that PMI payment.
Yep. And pro tip, you have to ask the lender. They're not going to call you and say, hey, do you want to lower your payment? Correct. You gotta contact them. And even then, it does sometimes take a minute.
Yes. So you can ask for it to be removed once you get 20% equity. Once you get to 22% equity is when the lender will automatically take it off. So they're going to get that extra 2%. So it's important to pay attention to what your home is worth from your realtor, so that sometimes that equity, the appreciation, maybe you have more equity than you thought you did. Yep. So you can ask for the private mortgage insurance to be removed. So also with a conventional loan, one of the perks of a conventional is that you can recast a loan. So
what does that mean?
Say you wanted to buy a house, you own one house, and you want to move and you want to upgrade, but you don't want a contingency on the contract, on the offer on the new home. Mm-hmm. So instead of doing a contingency, you can afford both payments and you're approved with both mortgage payments. So you get into the loan in a conventional and you put the minimum down, which if you are a repeat home buyer for conventional, it would be 5%. Okay. So you put your 5% down. Then you move in, you list your current house that you were in, you eventually sell that, and now you have a lump of cash that you want to do something with. So maybe you have $20,000 and you want to put a big portion of that towards your mortgage, your new house that you just got. So instead of refinancing, because you want to keep your current interest rate, and it's probably too soon to refinance because you just bought it, you would take that lump sum and you tell your lender that I want to recast. So they're going to put that whole $20,000 towards the principal of your new loan, and then they will re-amortize. So that means they'll adjust your monthly mortgage payment to lower. If you were to not recast and just put $20,000 down, it wouldn't change your mortgage payment, right? You're just lowering your principal.
You would put the chunk to the principal, but it wouldn't adjust the payments over the course.
Yes.
Oh, wow. But you have to be able to afford both houses in the first place to do that.
Yes.
I've also heard of loans called USDA loans. What's with that?
So a USDA loan is for rural development, or some people say RD. So a USDA loan is going to be based on the location of the property. So it was meant to encourage development outside of the city. Mm-hmm. So in the Huntsville area, a lot of places will qualify for USDA.
It's kind of shocking. Yes. This is something that you guys should know, because in the Huntsville area, you do not have to go out very far for it to be USDA eligible. So all you have to do is ask your lender or your agent to look it up. There's a website, you can check it out, and you can look up your address and find out if it's eligible.
Mm-hmm. There are requirements for USDA, so it's going to be a little stricter on your credit score again. The debt to income ratio is going to be even tighter.
And then there's income limits. I think that's one of the biggest things about USDA is the income limit is fairly strict.
Yes, so you can't make above a certain amount on a USDA loan, and it takes into account everyone in your household.
And the other big perk on that one is what?
Zero down.
Zero down.
Yeah, so there's no down payment.
Yep.
So you still will have your, closing costs, which Paula will negotiate for you, the seller,
of course,
to pay those. But yeah, so it's a good way to get into a house when you don't have a lot saved, mm-hmm. but you're in a good position financially to make that monthly payment.
And yeah, I've had several clients that the USDA has worked really well. Mm-hmm. Now, there are stricter things like on the inspection, repairs, those kinds of things. Can you address that?
Yeah, USDA, and I don't know about USDA if they're really stricter. Are they?
They are.
They are. Okay.
They're not as strict as VA, but they are stricter than FHA and the others.
Okay.
They don't really, well, I mean,
you
FHA.
think they're stricter than FHA?
No.
I would think they're like conventional.
I think they're similar to FHA.
Okay.
Okay, so let's start that again. So USDA does have some strict guidelines regarding repairs and mm-hmm. the condition of the home, kind of like FHA, which we did skip over that, but they're very similar. Mm-hmm. So can you talk about that?
So different programs are going to have different requirements for the structure of the home to be up to a certain level. So a big one like for FHA is going to be chipped paint, exposed wood, and USDA is going to be similar to that.
Yeah. And the reason this is important is when you are the seller and let's say you get multiple offers and one of them's a conventional loan and one of them's a USDA loan, the conventional loan will not require as many, does it have any? Does the loan actually, I mean, aside from the house being habitable, it's not going to complain about the paint.
No, there's going to be some
your appraisal,
requirements, but
the appraisal the house has to appraise, but there's not things that FHA and USDA will have, like the chipped paint or the need for a railing here or whatever.
Right.
So sometimes as a seller, if all things being equal, a seller is going to probably choose the conventional loan over the USDA or FHA loan on the offers. So
correct.
You should know that.
Yes.
And then VA is the last one, I guess.
So the VA loan is a great program. It's for the veterans.
Only.
Veterans only.
There's no exception here.
Yes. So VA is a program where you can put zero down, another zero down program. It also has a funding fee like the FHA and USDA that gets financed in, or it can get financed into the loan amount. Some veterans are going to be waived, so they don't require to pay a funding fee, and that'll be showing up on their certificate of eligibility.
Oh, and that could save thousands.
Yes. So VA, you have a certain amount that you are entitled to. That'll also show up on your certificate of eligibility.
Okay.
And so you can only get up to a certain amount in order to get that zero down.
So those are the different kinds of mortgages that a person can get. And the thing that I have learned in real estate is that you can go to a bank that you bank at and you can go get your mortgage there, or you can call up Rocket Mortgage on the internet and you can go there. But not all mortgage companies are created equal. There's different fees, different expenses, different things that are going on in the cost of the mortgage. So you might be thinking you're getting a really great deal, but then you're getting hit with fees on the other end. And what I like about your situation is that you're a mortgage broker.
Correct.
So can you tell us what it is that you do?
Yeah, so as a mortgage broker, I have access to different lenders. So I work with different lenders directly, and that means I can get you the best interest rate by looking at all my different lenders that I work with. I also have different programs that I'm able to get you. So maybe I have somebody that is a little bit more credit challenged, so I have a lender that I can go with for that direction. Maybe I have somebody who's self-employed and they want to do a bank statement loan and just use their bank statements to buy the house and not look at tax returns. So I have a lender that can do that as well. So as a broker, we have a lot of different avenues we can look at for clients and serve a lot of different people. We also don't have banker's hours. So people have my cell phone, they text me, call me whenever you're ready to get pre-approved, or you have a question on a house you're looking at, or talk about what the mortgage payment will be on a house that you fell in love with on a Saturday, then you have me to walk you through that.
That's a really nice feature. Working with a bunch of different buyers, I have worked with both. People getting both, right? A lot of people are very loyal to their bank, and so they want to go through their bank. But if I have an issue if we have a problem or a question or anything with your mortgage, and it's after 5, really after 4,
right? You're
not going to get an answer until Monday.
Yep.
So, exactly. But with Kari, you're going to get that what do you call it? Speedy service.
Speedy service. And also, you don't have me for just getting you into a mortgage. Like, I'm not going to get
You're like Jimmy John's.
Yeah.
Freaky fast.
I'm not going to get you into a mortgage and then,
yeah,
good luck. So a couple of weeks later, if you have questions on this absurd amount of junk mail that you're starting to get, you can text me a picture and I'll tell you if it's junk or if you really need to do something with it.
Yeah.
You can call me if you hear the news about interest rates going down and see if, hey, Kari, can I refinance?
Yeah.
Not yet, but hold tight. I got you on the list, you know?
Yeah. Yeah. That's really a helpful thing. That's your deep dive on mortgages. Kari's my go-to girl when it comes to real estate mortgage loans. So if you are looking to buy or sell in the Huntsville area, give us a call.